Okay, whose mom doesn't do this? Let me check for a fever, right? Let's put our collective hand on the forehead of the U.S. economy. Guess what? The temperature shows right now we are humming along just fine. Today's ADP report, this is the report on private sector job creation for October, blew away estimates. 222,000 jobs created this month. The expectation was something like 189,000. So really nice move there. The Employment Cost Index, the ECI, shows wages grew at the fastest rate in a decade. The U.S. economy just clocked one of its best six-month stretches in the past decade. Growth up 4.2% in the second quarter and 3.5% in the third quarter. But check out this headline from the Wall Street Journal. The U.S. economy is flashing signs it's downhill from here. What? What, John Hilsenrath? You're the article's writer. Tell me what's behind this.
Well, you know, as you just said, we just finished one of the best six-month stretches we've had in the past decade in terms of economic growth. And we survey economists every month. And the economists that we're talking to, the Wall Street economists who are out there listening right now, are projecting that the economy, that economic growth is going to slow down over the next year to 2.5% growth by the first quarter, 2.3% growth a year from now. And the Federal Reserve is projecting growth of 1.8% out to 2021. So we've had a very strong stretch of growth. The economy is certainly doing well. Wages are picking up. Unemployment is very low. But a lot of the people that the experts, so-called experts out there that we talk to, say a slowdown is coming.
I am constantly equating it to a Ferrari or a Citroen Maserati, one of my favorite cars. Dad had one back in the day in the 80s. But if you're going this fast, like a race car, the gasoline eventually gets depleted out of the tank and then you have to refill. Does that necessarily mean we're facing a recession?
No, it certainly doesn't mean we're facing a recession. And actually, at this point next year, we will be in the longest expansion in the post-World War II history of the United States. We're going past our 10th year. So, and you know, that downhill from here headline doesn't suggest at all that we're heading towards a recession. It just means that this fast pace of growth that we've had looks like it's going to slow. And let me explain a little bit why. I'll point to a couple of things. One is on the consumer front. We've had really strong consumer spending for much of this year. Part of that is because consumer confidence is very high, unemployment is low, incomes are strong. That's all really good news. It's also because there's an added oomph, so to speak, from tax cuts. Now, if you look at the history of tax cuts, a lot of the initial impetus from tax cuts comes in those first couple quarters after they happen. So, you know, we might not be able to keep up the consumer spending growth that we had. But the more important factor is on the business investment side. We actually have seen business investment slow down a little bit in the last couple of quarters. And when these corporate tax rates were cut, the hope was that business investment would really charge up. In order to keep an economy going at a faster growth rate, you need more worker productivity. Worker productivity comes from business investment. So we need to see more of that, and not
what they do with all the
investment.
money, John, they brought in some of the biggest companies billions of dollars because they got the break on repatriating their overseas profits. They're not spending it to build plants, are they? They are doing share buybacks, which is precisely what some people warned they would do. They're not hiring. You just saw General Motors. They are asking 18,000 employees to take buyouts.
Right, and you could say that's creative destruction at work, and that's not necessarily a bad thing, especially, you know, at a time when the unemployment rate is very low. There has been strong job creation.
True.
But what you really want to see is that business investment rate picking up. Now, you know, you mentioned buybacks. That's one area where the money is going. Business investment, you know, it did pick up earlier this year. A lot of it went into the oil and gas sector, a lot of investment in those oil rigs. But as oil prices have flattened out, we just saw energy structure investment go down in the third quarter.
Well, I'm looking at oil right now. It's at $65 a barrel, and it was just about a week and a half ago closer to 70. So it's an interesting perspective here. Read the article in the Wall Street Journal. Hills and Rath is one of the best. Thanks, John. Good to see you.